The Australian dollar has been very heavily sold over recent months, and the latest COT report, Commitment of Traders report, shows that large speculators have record short positions. This is the largest short position of the G8 currencies, with over 80,000 contracts short. However, the last RBA interest rate meeting showed that the board is struggling for reasons to keep the Australian dollar weak. Their own projections see inflation rising to 3.25% in the near term, before dropping to 2.75% over 2023. That is still within the 2 to 3% range that the RBA have set for their inflation target. This means that markets will start to question the more cautious and conservative approach that the RBA are currently taking about being slow on indicating future interest rate hikes. Also, positive PMI prints from China this week also should support Australian dollar prices over the medium term. Now, this is where Seasonax comes in so helpfully. You can see that the Aussie US dollar pair has strong gains between 19th of March and 28th of April, seeing an average return of 2% and gaining 13 out of those 20 years. The average maximum gain rather comes in at an impressive 13.13%, and the largest loss was 3.46% in 2004. There are trade risks associated with this outlook. The first one is that if the geopolitical risk continues to worsen with this very sad situation happening between Russia and Ukraine, that can result in bids into the US dollar and sellers for the Australian dollar, which would negate this outlook. The other risk, of course, is that the Fed are even more hawkish than the market's expecting, and that can result in further bids into the US dollar. So remember, don't just trade it, Seasonax it.